Welcome, everyone. Let's continue our journey into the world of finance and investing. In today's session, we'll focus on investment companies, mainly mutual funds and ETFs. We'll look at what they are, how they're structured, the costs involved, and how they perform. This is important because for most investors, these funds are an important gate to the financial markets. Let's start with the basics. Investment companies are what we call financial intermediaries. Think of them as middlemen who collect money from individual investors like you and me, then take that pool of money and invest it across a range of securities or assets. Now, why would investors use them instead of just buying stocks or bonds on their own? Well, these companies provide a set of very important services. First, they handle administration and record keeping. Imagine you had to track every dividend, every bond coupon, every trade. You'd spend more time on paperwork than investing. The investment company takes care of all of that. Second, they provide diversification and divisibility. With just a small amount of money, you get exposure to a broad portfolio of securities. If you had only $1,000, buying a diversified basket of 50 or 100 stocks on your own would be impossible. But through an investment company, that could be done. Third, there's professional management. Instead of you spending hours analyzing financial statements, the company employs skilled managers who do this for a living. And finally, you get reduced transaction costs. Because the company trades in bulk, it gets better prices and lower fees compared to what a single small investor would pay. So, overall, investment companies make investing more accessible, more efficient, and less costly for ordinary investors. Now, a key concept we need to understand is the net asset value, or NAV. This is basically the per share value of an investment company. Here's how it works. The NAV is calculated as the market value of all the assets in the portfolio minus any liabilities divided by the number of shares outstanding. Mathematically, NAV equals market value of assets minus liabilities divided by shares outstanding. Why does this matter? Because the NAV is the reference point used in two important cases: when the company is selling new shares and when it is redeeming existing shares. So if you invest in a mutual fund, for example, the price you pay, or the amount you get back when you sell, is tied directly to the NAV. It's the fundamental way we measure the value of these investment vehicles. Next, let's look at the main categories of investment companies. The first type is the Unit Investment Trust, or UIT. This is a fixed portfolio. Once it's created, it's not actively managed. Investors buy into it, and the securities inside remain more or less the same until maturity. Then we have managed investment companies, which are actively overseen by portfolio managers. These come in two main forms. One, open-end funds, which you probably know as mutual funds. Here, the number of shares changes all the time. New shares are created when investors put money in, and shares are redeemed when investors pull money out. The pricing is always at net asset value, the NAV we just talked about. Two, closed-end funds, in contrast, have a fixed number of shares outstanding. Unless the fund decides to issue new stock, the supply doesn't change. These trade on exchanges, and here's something interesting: they don't always trade at NAV. Instead, the market price could be at a premium or a discount relative to the NAV. Now, you might get confused between the unit investment trust and closed-end funds, since both have a defined set of investors from the beginning that will not change in the future, but they differ in important ways. A unit investment trust holds a fixed portfolio of securities, has no active management, and usually comes with a set termination date, where investors redeem units at net asset value through the sponsor. In contrast, a closed-end fund is actively managed, generally has no maturity date, and its shares trade on exchanges like stocks, often at a premium or discount to their net asset value. While UITs are designed for predictable buy and hold income streams, closed-end funds offer more liquidity and flexibility, but with added risks from market pricing and leverage. A more recent innovation is the Exchange Traded Fund, or ETF. These also trade on exchanges like stocks, but they typically track an index and combine some features of both open-end and closed-end funds. And then we have a few other types of investment organizations. For instance, one, commingled funds, where groups of investors, often institutions, pool money together in a partnership structure. Two, REITs, or real estate investment trusts, which focus on real estate assets. Three, and hedge funds, which are lightly regulated and often pursue more aggressive or unconventional investment strategies. So, as you can see, the landscape of investment companies is quite broad, each with its own structure and advantages. Mutual funds come in many forms, each designed with a different investment objective. Let's briefly walk through the main categories. Money market funds invest in short-term, highly liquid instruments like treasury bills or commercial paper. They are considered very safe but offer modest returns. Equity funds come in two flavors: income funds, which focus on dividend paying stocks, and growth funds, which target companies with high potential for capital appreciation. Sector funds are specialized vehicles that concentrate in a single industry, such as technology, healthcare, or energy. They carry higher risk due to lack of diversification. Bond funds allocate capital to fixed income securities, corporate bonds, government bonds, or municipals, depending on the mandate. Their risk return profile depends heavily on interest rate movements. Balanced funds, who also include funds of funds, combine stocks and bonds to balance growth and stability. They provide a one-stop diversified portfolio. Asset allocation and flexible funds are more dynamic. They allow managers to shift across asset classes depending on market conditions. For instance, a fund might increase its equity allocation in bull markets and tilt toward bonds during downturns. Index funds replicate the composition of a specific benchmark, like the S&P 500. These are often structured as ETFs when listed on exchanges. Finally, international mutual funds offer exposure outside the domestic market, giving investors a global portfolio. This can be achieved within a single fund instead of buying multiple ETFs to cover different regions. Now that we've mapped the main fund types, let's turn to the costs involved. Every fund charges fees, but these costs are rarely advertised up front. They matter because they reduce your net return. The most visible are operating expenses and management fees, often between 1% and 2% annually. Then we have front-end loads, fees charged when you buy into the fund, and back-end loads charged when you exit. For example, investing $100 in a fund with a 5% front load means only $95 is invested on your behalf. There's also the 12B-1 fee authorized by the SEC, which covers distribution and marketing costs. Instead of paying a load up front, the fund uses this fee to compensate brokers and distributors over time. In practice, it's another way investors absorb sales costs. Always read the fee disclosure carefully. It's usually hidden in fine print. Once invested, calculating returns is simple. Take the ending NAV, net asset value, add any income or capital gains distributions, subtract the initial NAV, and divide by the initial NAV. For example, initial NAV, $20 income distribution, 15 cents, capital gain distribution, 5 cents, ending NAV, $20.10, return equals $20.10 plus 0.15 plus 0.05 minus 20.00 divided by 20.00 equals 1.5%. This same logic applies to stocks, price appreciation plus dividends over the previous price. Mutual funds in the U.S. have pass-through status. This means they don't pay taxes at the fund level. Instead, all income and gains pass through to you, the investor, who must report them on your tax return. The challenge is that high turnover funds, those that buy and sell frequently, are tax inefficient. Gains from short-term trades are taxed at higher rates, and you may owe taxes even without selling your shares. By contrast, ETFs are generally more tax efficient because their structure involves fewer taxable events. Investors who want more control sometimes use separately managed accounts, SMAs, which allow harvesting of tax losses to offset gains. ETFs allow investors to trade index portfolios like shares of stock. Two well-known examples are SPY and IVV, both tracking the S&P 500. There are also international ETFs, such as WEBS. Advantages include continuous trading throughout market hours, lower costs compared to mutual funds, lower taxes due to structural efficiency. Disadvantages include, in less liquid ETFs, prices may diverge slightly from NAV. This tracking error is usually small but worth noting. Managing ETFs is operationally complex, though this is a burden for the fund manager, not the investor. For most investors, ETFs remain one of the best trading tools in efficient markets. Decades of research, including work by Burton Malkiel, show that the average mutual fund underperforms the market after fees. Moreover, evidence of consistent performance is weak. A fund that performs well one year has little more than a coin flip chance of performing well the next year. This undermines the myth that good managers always stay good. This raises the central question: can we consistently beat the market? That question will guide much of our future discussions on market efficiency. Mutual funds are sold in different ways. Some are direct marketed, sold by the underwriter or fund manager directly to investors. Others are Salesforce distributed, sold through brokers who earn commissions. Here, revenue-sharing agreements may create conflicts of interest. Increasingly, funds are sold through financial supermarkets, online platforms where investors can choose among a wide array of funds. In such cases, brokers often split management fees with fund managers. Understanding the distribution channel helps you evaluate incentives and potential biases. Several resources provide detailed information about mutual funds. Wiesenberger's Investment Companies, one of the oldest references. Morningstar, widely used for ratings, performance analysis, and risk metrics. Yahoo Finance, free and accessible, even used by Wall Street professionals for quick reference. Investment Company Institute and various fund directories also provide reliable data. Before investing, consulting these resources can help you compare costs, returns, and risks across funds. This session has given you a broad overview of mutual funds, their costs, taxation, ETFs, performance evidence, and how they're sold. It's one of the lighter lectures. From here, the course becomes more quantitative, involving Excel-based exercises on portfolio optimization and efficient markets.